Okay, so I guess we're going to get started now for the first time homebuyer seminar. So everyone's been told there's refreshments in the back. The restrooms, for those who just came in, are out the back doors, limited to the left and then to the right. And I'm Amy. I'm going to be presenting tonight, and I'm with the mortgage department here. So right now, Stacy, and I'm a loan officer, obviously. Stacy is also one of our loan officers, and she's handing out tickets for our giveaways that we're going to have at the end of the seminar. So you want to stick around because it's going to be exciting stuff. And everyone should have a first-time homebuyer packet. And if you don't, raise your hand. I think everyone got one though. You need a first-time homebuyer packet? Okay.
Yes, please.
Okay.
Thank you, God.
Yeah, okay. Okay. Okay, and if you can't hear me, let me know. Okay. Okay.
Thank you.
Anybody else need a packet? Okay, so like I said, Stacy is one of our loan officers. We also have Brenda and Brandy. If you want to raise your hands. They are also loan officers here in Lewiston. Our manager, Mike, is in the front row, just so you know. You can raise your hand, Mike. So, and then we also have loan officers in our Moscow and Post Falls branches. And so we also want to welcome Orfino. We have some folks in our Orfino branch joining us tonight, and we have a few folks in their homes joining us via the internet. So, okay, so to get started, I thought we would give a definition of the first-time home buyer. So if you've never owned a home before, you're a first-time home buyer. But also, if you haven't owned a home in the past 3 years, you owned a home previously, you would also be considered a first-time home buyer. And then if you're married and one of you has never owned a home or hasn't owned a home in the past 3 years, but your spouse is a current homeowner or has owned a home in 3 years, you're still considered a first-time home buyer. So just a little FYI, because it's not just for someone who's never owned a home before. So what we're going to go over tonight is how to prepare to buy a home, and what you want to do is get pre-qualified. We'll go into some of the items that you would need to get pre-qualified. We want to talk about the importance of realtors, because as a first-time home buyer, I think it's really good to have someone there on your side, preparing a contract with the seller, asking for things that you might not be aware of that the seller could pay for on your behalf. Getting the right price for the property, because you definitely don't want to overpay for the property. Let's see, what else? They can do all the legwork for you. You know, if you're working hard every day, you don't have time to go out and check out all the properties that might be out there in your price range, and so realtors can do that for you as well. So for a first-time home buyer and subsequent home buyers, I always recommend realtors are a great thing to have on your side. You'll also run into properties that are for sale by owner, and they're great transactions as well. They can be. The one thing I would mention about a for sale by owner is that you're not going to get very much advice from a loan officer, for example, because we're not a licensed real estate agent. And so if you have questions about anything regarding real estate, there's no one to ask. You'll need to talk to a realtor about it. So you could also use a realtor if you find a property that's for sale by owner, and the realtor can still work on your behalf. They won't be representing the seller, though. So, and you'll find them out there for sale by owners. Okay, so the time frame, probably one of the longest pieces to buying a home is looking for the home, because you want to get the right one. The time frame once you find a property until you actually close with the title company is approximately 45 days. And during that time, the lender will get your loan officially approved with the underwriter. We'll order the appraisal. collect all the documentation that we need from you, and then issue your loan approval, and then move to the title company for closing. And you can ask any questions along the way, okay? Okay, so first-time home buyer. What we offer at Collateral Credit Union are conventional loans with, for a first-time home buyer, a minimum down payment of 3%. So we're also offering a special deal right now where you can save some on your closing costs. And what we're offering for first-time home buyers is half off of the origination fee. So if you purchased a home for over $424,000, the maximum loan amount we can offer you is $424,100, which is quite a lot for a first-time home buyer. But you could save up to $2,120 on your origination fee. A typical loan would be a loan amount of $150,000, and 1% origination is $1,500. So you could save up to $750. So if you're looking for a property, you want to get pre-qualified, pre-approved with us, definitely give us a call, come in, get pre-qualified, and you will be eligible for that half off of the origination fee if you are a first-time home buyer. So, any questions on that? Okay, so...
So on that loan, is there mortgage insurance with that little down payment like an FHA loan would have? Or?
There is mortgage insurance. Mortgage insurance is required, and we're going to talk about this on a couple slides down the road, but it's required anytime you don't have a full 20% down payment. And then it drops off after you reach the 20% equity mark, so it does eventually go away, yes.
So is the half-off loan origination fee just for those that came to this meeting, or is that anyone? Good
question. Okay, the question is it the half off the origination fee just for folks at this seminar or for any first-time home buyer? And it's for any first-time home buyer. Through the end of March, we're running this special. So yeah. So you have time to get pre-approved, make an appointment, apply online. We can talk about those things as well in a minute. Okay, so one thing that we've been advertising is the grant funds that we have available for our first-time home buyers. And what it is, it's there's money that's provided by the Federal Home Loan Bank for first-time home buyers, and Potlatch is a member of that program, and it's up to $7,500 that can be used toward your closing costs and down payment. It is income-based, and as long as you qualify for the mortgage with your credit, your credit scores, your debt ratio, if your income qualifies, you'll be eligible for that money. Okay? And I think we had a question about the grant funds. Did you want to ask your question now?
Yeah. What's the qualifications, like the amount for it that you have to make per year?
Okay. There is, let me just flip back to the next, we'll flip over here and then we'll go back to that slide. So here are the income limits, and we've listed 3 because they do vary by county, and then Washington State versus Idaho State. But you can see there, it is for lower income households. So in Nez Perce County, a one-person family, the maximum you can earn on a yearly basis is $33,250. And that's for where you buy the property. So if you're buying in Lewiston, that's what you could earn.
Do your student loans and car loans, any of the loans add to your overall income to qualify for that?
No. Your student, the question is, do student loans come into play for the income? And those actually come into play in your debt ratio because it's considered a liability. Okay, so in Washington State, you can see it really jumps up a little bit. So if you were buying in Washington State for a one-person family, it's $41,050 a year. So the larger the family, the more you can earn. So we've only given you 3 examples, you know, one person, a couple, and then a 3-person. It could be a single person with 2 children. So the more in your household, the more money you can earn. If you have older children that are employed that bring money into the household, that income is also included in the overall income limit. So it's based on the household income.
Quick
Yes.
question on the where you reside for the counties or the states. Is it where you currently reside or where you're actually purchasing your home?
The income limits apply to where you're purchasing the home. Okay? Yes.
Sorry, if you were to pick up a renter after you entered your home, would their income also count? And if it did, what happens if you exceed that limit?
So the question is, if you have a renter after you purchase the home, does it affect the grant money if you're eligible? It does not, because that happens after you get the loan.
Okay.
So, yes.
There was an online question, and they wanted to know if the mortgage insurance was a one-time fee or a monthly premium.
Okay, so the question is the mortgage insurance a one-time fee or a monthly premium? And what we offer is a monthly mortgage insurance premium that's collected with your mortgage payment. That's what's typical on the conventional loan, and that's what we offer. There are other programs that offer a upfront fee that's financed onto the loan, but we don't do those kind of loans. So, okay, so I also gave you household limits in other counties. So it does depend on where you're going to purchase the home. Other counties, Clearwater County would be $32,300. So check if you're getting pre-qualified. Just check with your loan officer on what the county limit would be. Okay, so since we're on the grant funds, the $7,500 can be used toward, as I said, your down payment and closing costs. If your down payment and closing costs does not total that amount, the rest of the money is applied to the principal balance of the loan. So we would ask for the full $7,500 for you, even if you didn't need all that for the loan. It is a silent second that's recorded. The $7,500 is a silent second, so it's a second mortgage that would be recorded with the county after our first mortgage. And after 5 years, it's totally forgiven, meaning it goes away. If you were to sell the property in the first 5 years, if you made a profit on the property, you may have to pay back some of the $7,500. And then if you refinanced in the first 5 years, the second mortgage is still on there, so it's for a total of 5 years. But it's free money, so you can't lose with the program. Okay.
Question on that?
Yes.
So is that an ongoing program for the foreseeable future, or are there some time limits? Or?
Well, that's a really good question, and the question is this an ongoing program? And I don't know the answer to that because it is provided through the Federal Home Loan Bank. The program has been out there for a number of years, but like, you know, all programs, it could go away. I'm hoping it doesn't, but yeah, we don't know the answer to that. Okay, so if you are eligible for the grant money, there is a class that you're required to take for the grant funds, and it's called Framework. It is a $75 course. It takes about 4 hours on the internet. And if you're here at the seminar, this is the one caveat for this seminar, is that we will pay for that class. And in your packet, you'll have a coupon that you just need to bring with you when you apply for your loan, when you meet with your loan officer. And we'll pay for that class. Okay? And it's all about first-time home ownership. It's a really good class. I almost finished taking it, and it goes into a lot of detail, and it really makes you think. But it's a really good class. I recommend it for everyone, even current homeowners, because I'm still learning stuff. Okay. Okay, so any other questions on the grant funds? Okay. So what are lenders, oh, yes?
You guys are like half. First-time homebuyers get 50% off their loan origination, or what was that?
Yes. First-time homebuyers, through the end of March, if you get your loan with Potlatch or apply with us for a pre-qual, we will discount your 1% origination fee to 0.5%. So, and the example is if your loan amount is $150,000, your 1% origination fee would be $1,500 typically. So half of that is $750. So it could save you a little bundle.
Did you ask, or did you answer how, somebody asked how long the grant money was available? Did you end that?
I didn't, and actually you do have there's a second part to that question. So the grant money that we have available is $250,000. So divided by 7,500 is roughly 33 loans. It becomes available, so we have that many loans to do in 1 year. And so next year, assuming the program will be there, and I don't know why it wouldn't be, we would also have the same amount, hopefully even more money to use. So, but we have a limited amount of money. So, and just an FYI, in previous years, the grant money was $5,000, and they just raised it to $7,500 this year. So that's a very positive thing, and who knows in the future if it's going to go higher. So what we're looking for as a lender, we're going to look at your debt ratios. And so what we want to look at is how much income you make, your gross monthly income, and roughly, and when I say roughly, it's because there's always a little give and take when it comes to things like ratios. But 31% of your gross monthly income can typically be used toward a house payment, and 45% of your total debt, so 45% of your total gross monthly income is can be used toward your total debt, including your house payment, credit cards, auto loans, those kind of things. There are quite a few things that aren't included with that debt ratio, things like child care, your cable TV, your cell phone, things like that. So the 45% debt ratio is a benchmark, but as home buyers, you want to make sure that you know what else you pay out of your paycheck, because it can add up quickly. Okay, so we're going to look at your ratios, look at your income. We're going to look at your credit report, and our minimum credit score requirements is 620. So we can't do a conventional loan if it's below 620, and there aren't very many options in the marketplace if your credit score is below 620. There are a few, but like I said, they're very limited.
I have a quick question on that. Can a very good credit score override the requirements of the debt ratio, or I mean those are pretty
well,
set in stone?
Yes, they are pretty well set in stone, especially the total debt ratio. I mean, if your credit is excellent, the housing payment, you may be able to go a little bit higher, but overall, the 45% overall debt ratio is a pretty hard and fast rule. So in your packet, I want to talk a little bit about the credit report. In your packet is some instructions on how to get your annual credit report, which is for free. You can pull your annual credit report. And if you just have any items that you don't believe are true, there are instructions in the packet on how to dispute any trade line, so any account that's reporting on your credit report that you don't believe is true. So I highly recommend that everyone get their credit report. The website is on there. And just so you know what's out there, and then you can start disputing it. The instructions are there. When you are pre-qualified for a mortgage, we're also going to pull your credit report. So we don't dispute the accounts for you. That's something that you have to do yourself. But we can go over your credit report with you and help you in those ways, as far as just letting you know what steps you might take to improve your credit score. There's also in your packets, we've partnered with a financial wellness company, and it's called Green Path. And in your packet are some brochures regarding that company. But they can do a free credit report review and help you get on track to improving your credit scores. So once you've pulled your credit, or if you meet with us and realize your credit isn't that great, or your credit score is below 620, I would definitely refer you to Green Path, because they're going to be the experts on what to do to get your credit up.
Do they charge fees?
The credit report review is free. They have some services they do charge for. If you tell them you're a member with Potlatch Credit Union, they'll be able to do as many free things as possible. But one of the things is the credit report review. Okay. So income trending is very important. In the old days, you had to be on your job for 2 years, kind of a hard and fast rule, and that's not necessarily the case. If you change jobs because you've got a huge pay increase, that would make sense. Who wouldn't do that? So that's kind of where income trending, kind of what that means. If you change jobs because your commute was forever and you got a job closer to home, those kind of things make sense. So if you're a W-2 employee, changing jobs isn't a detriment like it used to be. If you're self-employed, we definitely want to see a 2-year history, and that means 2 years tax returns doing the self-employment. So it is a little bit different if you're self-employed versus a W-2 employee. Okay, any questions on that?
How much of a history of W-2, being a W-2 employee, do you have to have?
Very good question. And the question is how many years experience, or how many years W-2s do you need?
Yeah.
You need at least a 24-month employment history. So if you just got out of high school and you have no job history, that's going to be a problem. But if you just got out of college and if you're going to be employed in the same line that your degree is in, we might be able to make that work for you. But it is typically a 24-month employment history is what we're looking for. Yes?
What if people retired don't have a income from a job?
Okay, the question is, what if you're retired and you don't have income from a job? That is perfectly okay, as long as you have retirement income. Yeah, and you don't need to be retired for 2 years, let's say. You retire tomorrow, and as long as your income supports what's required as far as your debt ratios, you're going to be just fine. Okay. Okay, so assets for money for down payment. We will require your last 2 months' bank statements from whatever institution you bank with. Hopefully it's Potlatch. If it's with us, we can pull your bank statements. It's one less piece of documentation that you would need. But wherever your money is for the down payment and closing costs, we need to verify it with 2 months' worth of statements. If there are any large deposits on those statements, we need to know where the money came from. It's not our requirement, it's our investors' requirement, and some of that requirement is based on government regulations. We want to make sure that you're not, it might sound kind of silly, but that you're not filtering money for terrorism, or you're not drug dealing, things like that. So large deposits have to be sourced, is what it's called.
What's a large deposit? 2,000, 5,000?
Yeah, anything like that. Over 500, let's say. And it also depends on your income limit or the income that you bring in, but typically, 500 or 1,000 and up will be questioned. When we also want to make sure you haven't borrowed that money and you have some debt that we haven't included in your debt ratio. So there are a number of reasons why we need to know where that money came from. Yes?
Does that require official documentation or just like a verbal report?
The question is, does it require official documentation? And the answer is yes. We need to know where it's from, first of all, and then after we get your answer, then we would tell you what we might need for it. So if, it's going to be hard if you had a yard sale and made $700 and deposited it. That's going to be hard to trace. But if you did some odd jobs for someone and they paid you with checks, we would need copies of the checks, things like that. So insurance payouts, things like that can be traced fairly easily. So yeah, we can't just take a verbal. Okay. And gift funds, oops, I got a little ahead of myself. Gift funds are acceptable, even at 3% down for 3% down payment programs. We do require a gift letter from an immediate family member, so it's mom, dad, grandma, grandpa, aunt, uncle, brother, and sister. They sign a letter that it is gift money, and then we need a copy of the check that you get from the donor. Was there a question in the back? Okay. Any questions on the gift money? Okay. Okay, collateral, and that's the house that you're buying as our next topic. So what we require as a mortgage lender is an appraisal. And that gives us the value of the property, and we want to make sure that the value is at least as high as your sell price, because we don't want you overpaying for a property. We don't want you to, pay more than what it's worth. So the appraisal gives us the value and also that the property is marketable and that there aren't any significant safety issues. For example, you have a really steep stairs going to the basement. We're going to expect to see a handrail that goes down to the basement. If the roof's in really poor shape, the appraiser may call out for a roof inspection, which could lead to a new roof being required. So there are going to be fairly significant items that the appraisal will look for. There also are some minor things that laws dictate, like in Washington State, you have to make sure you have the CO2 detector and the carbon monoxide, and then of course we all look for the smoke detectors and things like that. So those are kind of small, but still required. So that is what we require as a lender. But as a home buyer, you want to make sure you get a home inspection. And the home inspections don't have anything to do with our loan. In fact, we don't even want to see them because a home inspector is going to point out everything that's wrong with the home. They're going to tell you what could go wrong in the future. They're going to give you the age of like the furnace and recommend that you either get a new furnace or get it inspected. And so they're going to go in very minute detail with everything that's, could go wrong and is wrong with the home. And that's good because you want to know what you're getting into. But we don't want to see that as a lender because it could open up a can of worms. And because what we want to see is that appraisal with the big issues, the big repairs, if there's any, and then the value. But to protect yourself as a first-time home buyer or any buyer, we definitely want a home inspection. Okay. Manufactured homes versus a stick-built home. So a stick-built home is just a traditional wood home, brick, whatever. And then manufactured homes. Manufactured homes, there's a little bit different. There are different requirements for manufactured homes. A 5% down payment is required. So as a first-time home buyer, it's 5%, not 3%, if you want a manufactured home. Manufactured homes, we can't do them if they're in a park because you need to own the land that's under the property, which that makes it real property as far as tax purposes. So it can't be in a mobile home park, it can't be on a rented lot, it has to be a double wide or larger, and it has to be built after July of '76. So those are the primary items on a manufactured home that would make it eligible for financing. Anything older than a 76 is not eligible for a mortgage, even if it is a real property. If it's a 2015 single wide home, we couldn't do it because it's a single wide home. So, and those are hard and fast rules. Okay, any questions on that?
Do you have manufactured home loans as the credit union offering outside of the first-time home buyer?
Yes, and the question is, do we offer manufactured home loans outside of the first-time home buyer program? And yes, we do. In fact, we're one of the few lenders that still do manufactured homes. It does have to be real property, and there's at least a 5% down payment requirement. And that's really the main difference, because even for a first-time home buyer, it is the 5%.
And it has to be double wide?
Yes.
So no single wide?
I'm sorry?
No single wide.
No single wides, that's right. Okay, and then I just want to touch base on foreclosed homes and HUD homes that you hear and see. And
Maybe we could do single wide on the consumer.
oh, good point.
I'm at 5% now on it.
25.
It's 20, yeah.
Right.
I think that's what she was asking, not as a mortgage.
It's treated like an RV loan.
Yeah.
Okay.
It's a titled unit, so it's a consumer.
Right, so I apologize. So on our consumer side of the credit union, we can do single wide homes. In mobile home parks, there's a 25% down payment, a 20% down payment, and the home has to be 25 years old or newer. So, and once again, Potlatch is one of the few lenders that still does that. But on the mortgage side, these are the requirements as far as a double wide or larger and a newer home and real property. Okay, so regarding the foreclosed and HUD homes, the main thing I wanted to touch on is just that sometimes when folks have a property that's foreclosed upon, and for those of you who don't know, you probably all do know what that is, but if their home is if they haven't made their payments and they're losing their property, some people tend to get a little violent and they'll poke holes in walls, or they'll take everything that's not permanently secured to the property, rip it out to take it with them to maybe sell it and make some money. So sometimes foreclosed properties can be a little rough on the interior and exterior. So you want to look closely at those homes before you jump on it because it's such a good price. It might be really inexpensive. Likewise, the HUD homes. It could be the same scenario because they are properties that have been foreclosed upon. When you purchase one of those homes, if there's any work that needs to be done, 9 times out of 10, you won't be able to do any of the work requirements until after you own the home, which is a catch-22 because we're going to require all that work be done before you can close on the loan. So they could get a little tricky. There are some great deals out there, but you just want to be careful that you know what you're getting into because there could be some repairs required on those properties. Okay, any questions? Okay, so insurance is our next topic. And there are 3 kinds of insurance I'm going to touch on. The first one is homeowners insurance, which is also called hazard insurance. This you will need for any mortgage loan, and as a smart homeowner, you'll want it even if you didn't have a mortgage loan. You're going to shop around for it. This is one service that you'll shop around. I would recommend you get at least 3 quotes for it so you can get the best coverage at the lowest price. And there is a pretty big variance if you shop the rates. I always tell people to start maybe with their auto insurance company, see what they can do, especially when you bundle it. You might be able to get lower rates. And depending upon the state, there might be insurance companies that will insure in Idaho but not in Washington, so definitely shop around for that. And that's going to protect you, in case of fire, injury, things like that. Private mortgage insurance, the gentleman asked about that earlier. This is required anytime you don't have 20% down. The lower your down payment, the higher the premium will be. So if you do come in with 3% down, you're going to be paying the highest premium for private mortgage insurance. It drops in 5% increments. So with 3% down, it's the highest. If you put 5% down, it drops a little bit more. In fact, it drops quite a bit more. 10%, it drops again, 15% again, and then at 20%, you wouldn't have it. So if you put 4% down, it might be, if you're really looking at the payments, try to come up with another 1% down, and you could save quite a bit on your private mortgage insurance. Yes?
So if your home appreciates and then that equity would make your 20% down, can you refi and lose that mortgage insurance?
Okay, so the question is, if your home appreciates and the value ends up being a lot higher, can you refinance and get rid of the private mortgage insurance? And yes, that's always a possibility. When you refinance, you'll need a new appraisal typically, and so that would give us the value. And if the value is high enough and you have at least 20% equity, the mortgage insurance wouldn't be there anymore. Okay. Likewise, if you are making your payments every month, but you make a little extra on your payment and you pay that principal balance down, as soon as you get to that 20% mark, you can request that private mortgage insurance come off. So
how can you request it?
When it gets to 80%, you request it. We ask that you put it in writing. It automatically comes off when you hit the 78% mark. So when you get 22% equity, it automatically drops off your loan.
The mortgage insurance is not a straight percentage of the loan value, or?
No, and the question is, the private mortgage insurance isn't a straight percentage of the loan amount?
Right.
That's correct. The private mortgage insurance is based on how much of a down payment you have and what your credit score is. So the credit score is a huge factor in all of this, and definitely the private mortgage insurance. It also, the type of property, if you're buying a manufactured home, it's going to be possibly a little bump to insurance rates, both for your homeowners and the private mortgage insurance. So another reason to get your credit up and have really good scores. Okay, the third one is flood insurance, and we do have areas here in Lewiston that are in the flood zone, as well as other areas in the state and in Washington also. If your property is in a flood zone, flood insurance will be required. If you choose not to get flood insurance, we would not be able to do the loan. So it's definitely a hard and fast rule that it would be required. And once again, you could shop around for rates on that as well. It can be very expensive. There aren't many flood zones, but they're out there. And the flood maps that the government provides do change periodically. So today, your property might not be in a flood zone, but if they redo the maps in 10 years, you could be in a flood zone, and that would be required.
And those are accessed through the FEMA.
They are FEMA maps, yes.
FEMA website.
Correct. And so one fee that you will pay at closing, it's called a flood search determination, and that is required on every loan. And then basically, for the duration of your loan, your property is monitored. And if it ends up ever being in a flood zone, based on the FEMA maps, you would need flood insurance.
And the structure has to be in it. You could have 5 acres of land and maybe 3 acres is in a flood zone, but if your house is not in the zone, you're not required to have flood insurance anymore. That kind of changed over the years, and it's actually the primary residence. So if your shop is in there, if it wasn't attached, you don't have to have that insured.
Mike is an expert on flood insurance because he has flood insurance. So it is, and he lives in Lewiston, so yes, so it's around. Okay, any other questions on that? Okay, so FICO scores. So here is a breakdown of what determines your FICO scores. So these are your credit scores. When we pull your credit report, we pull a tri-bureau report, which gives us all 3 repositories. Their formulas are ever so slightly different. That's why the numbers are going to be different. But your payment history will make up 35% of your credit score. The amount you owe makes up 30%. The length of your credit history is 15%. So if you were just starting out and you just opened up a couple new accounts 2 months ago, your FICO score is probably not going to be very good at all, if you even have one, because it takes some time and some number of accounts to develop a FICO score. The types of credit is 10%. So types of credit meaning a revolving charge card, credit card, versus an auto loan, student loans, things like that. And then inquiries and new accounts make up another 10% of your FICO score. So once again, I highly encourage you to pull in your credit, look through it, and make sure you agree with everything that's being reported, and if not, contest it. The instructions are in your booklet, because so many things nowadays are based on your credit scores.
So is it true that closing accounts will negatively affect your score?
Some accounts will. Revolving accounts could. I should say they could. If you close all of your credit cards and don't have anything open, that's going to have a negative impact, because the FICO scores are driven by how much you could possibly borrow against your credit card versus how much you actually owe against your credit card. So if you don't have anything to borrow, that's going to have a negative impact.
The whole capacity part just went away, which is 30% of your score.
Yeah.
In the old days, they did tell you to shut everything down. Remember? They said, well, we want you to shut all your credit cards down because we want to make sure you can make your mortgage payment. But now the score is the big key factor now. If you have a bunch available and a low limit, that's better than not having any.
Okay. Any questions on credit scores? Okay.
Can I add just one more thing?
Sure. You want to come up here?
Well,
Oh, go ahead. I want the people in the outlying branches to hear you too, Mike. So.
Just the only thing I would say is when you do go to those credit reporting places, Free Karma, whatever those are, do not take their score to heart. I mean, don't think that is your credit score. because you'll see it a lot of times, that is their credit module score, not the actual repository scores. And if you look at the fine print of how they say that, it does say that. I mean, it puts up in big things, oh, your credit score is this. Well, that's your credit score to their module. Okay? Because we do see a lot of people that will come and say, yep, I just pulled my credit on Credit Karma and I have a 9,000 credit score. Well, I'm exaggerating, but it's totally different.
Good point. Thanks, Mike. Okay, so recommendations for what you must do as a first-time home buyer. Once again, examine your credit reports. It's a crucial element. Get your documents together so you can make an application with a lender, and hopefully that's going to be potlatch. You want your pay stubs to cover the most recent 30 days. And they have to show your year-to-date income, and most pay stubs will do that, unless you work for mom and pop and they handwrite your pay stubs. Your last 2 years W-2s, last 2 years tax returns, your federal tax returns, and your 2 months most recent bank statements. Okay? Typically, that's what you're going to need anytime you apply for a mortgage. You need to find a lender and get pre-qualified. I would do that. I would recommend that you do that before you start looking for a house, because you don't want to go out there and look for that house that you've all of a sudden fall in love with, only to find out that you don't qualify because it's too much of a payment, or your credit score is 619. I mean, that's a heartbreak because you're so close, but you won't. Not even that close. There are no exceptions for the credit scores. So you want to find the lender, get pre-qualified, make a list of what you're looking for in a home so you don't set your expectations too high or too low. We highly recommend working with a realtor, so find a realtor. And like anything, you can ask for references, ask your friends who they used, things like that. Search for the homes in your price range, find a home, make an offer through your realtor. And then when you make an offer, make sure you get a home inspection, if at all possible, and a repair allowance to cover unexpected costs. So most sellers will cover maybe $250 and sometimes up to $500 for repair costs. So if they have to install a smoke detector, and that's what the appraiser says they have to install, that won't come out of your pocket, that would come out of the seller's pocket. No personal property can be included, so if you find a property on a huge lot with a great yard, don't ask for the riding lawnmower, okay, because that won't be allowed. So no personal property. Once you get an accepted offer, start shopping around for your homeowner's insurance. Once again, we recommend 3 quotes. And then complete the loan process with your lender. So, of course, we'd need the purchase and sale agreement and any last items that you may not have provided already to your lender. Okay. Any questions on that? Yes, Mike?
I have an online question.
Oh, good.
Yeah. Try to read this. For married first-time home buyers, are the individual credit histories combined, such as types of credit or length of credit history?
Okay, that's a good question. So the question is, for married folks, are the credit scores combined? Read that again, Mike. Are the credit scores combined?
Are the individual credit histories combined?
Credit histories combined. Okay, so the answer to that is no. Well, I should say kind of, sort of, but you both are going to have 3 separate credit scores, and it's based on all the credit that you each have, and if you have joint credit together, then that's going to influence both sets of credit scores. But if I have an account in my name only, it's going to be on mine, it's going to affect my credit score, or if my husband has one, it's going to affect his. So they can be joint, but if you have an individual, then it's going to be, it would affect it individually. So.
But let them know it's the middle score. The lower of the 2 middle scores is used for the whole parameter.
Yes, and so in mortgage lending, you each have 3 scores, and we take the middle score from each of you, and then we use the lower of the 2 scores. So that's how your loan is approved and priced for rates, but even the approval process, it's based on the lesser of the 2 middle scores. So hopefully the person in the outlying area, that answers your question. Okay. Any other question?
Yeah, how much does VA loans?
We don't do VA loans directly, but we have a partner that we work with that does VA loans. We can take your application here and provide all the documentation to our partner to get you the VA loan that you would want.
Okay, and this partner is?
It's CU members, which stands for credit union members, and they're a national firm. And what they do is they work with credit unions to provide the credit unions the type of loans that we don't have direct access to.
Okay.
Okay. Yeah, some programs require a high volume of loans to become an approved lender, for example, VA, and so we don't have that kind of volume. And so we partnered with this company so they can get the job done for us.
Yeah.
And our expectations of them is to treat you just like you're a Potlatch #1 federal credit union member. We want them to, provide the same level of customer service.
Okay. Yeah, the reason I'm asking is I'm wondering if there's a first-time home buyers program with VA or not. I don't know if that's.
I don't know the answer to that, but I would say no, because VA loans are zero down anyway.
You wouldn't need them.
Yeah, you wouldn't need them. Yeah.
There's no money down anyway. And no PMI.
Yeah.
So there's no.
Yeah, there's no down payment, no PMI.
214 and.
Yeah, and they probably would offer you the same rates as they would any veteran. I don't think they would discount the rate just because you're a first-time home buyer.
Right.
But that is a good question.
Okay.
Yeah. Okay, so we've pretty much come to the end, so does anyone have any questions? Yes, we'll start in the front.
Is there going to be any variances in loans between one to build your own home on property and a home that's already built?
As far as down payment requirements or?
Just loans in general, qualifications.
Okay, so the question is are there any differences if you build your own home or buy a home that's already built? So yeah, there are some differences. The down payment is going to be at least 5% to build your own home. You qualify for a construction loan at a slightly higher rate to account for the market changes until the home is built. What else is there? We just had the construction seminar.
I think you could do the grant money with that.
Don't know the answer to that. So there are some subtle differences. And if you are interested in the construction program, we did just have the seminar prior to this, but you could definitely call our construction lending department. In fact, there's construction lending right in the back. If you have questions, Brent, raise your hand. There's the construction lending manager, so if you want specific questions, you can ask Brent before you leave. Okay, yes.
So if you look like on your website, it says today's interest rate's 4.25%, no points. What assumptions does that include for like your credit score or down payment?
Okay, very good question. So the question is, if you look on our website today and see what our mortgage rates are, the assumption is that it's a 30% down payment and a FICO score over 740. Okay, but you'd be surprised if you bring your scenario to us. The rates are going to be very similar if you're not putting 30% down. I mean, there's not too much of a variation. Unless you were buying an investment property and had a 635 credit score, that's going to change things. So
if you got a 3% loan and it's saying 4.25%, what could you expect maybe?
It really depends on the pricing that day, but it still could be 4.25%. It really depends on what your credit score is and really the market conditions on the day that you locked your interest rate. And by market conditions, I mean the stock market and how that impacts the mortgage rates. And it can change daily. And our rates do change daily. Sometimes they change throughout the day, although we just publish them in the morning. So, yes.
2 comments. One, I'd encourage your buyers to go with the home inspector while they're taking the inspection, not just try to read the report. That way, they can ask the inspector what he or she is looking for while they're doing it, and what the potential cost would be to make any noticeable repairs.
Good comment. Let me just repeat that. This gentleman recommends that during your home inspection, and correct me if I'm wrong, that you spend the time with the home inspector to ask how much the repairs are going to cost and to understand exactly what he's doing. Does that sum it up?
That's correct.
Okay.
Because if you just get a report.
Right, if you just get the report, it might be meaningless if you don't understand everything that's in there. So that's an excellent suggestion. And what was your second comment? Did you have another one?
Typically, the appraisal is property of the lender, not the homeowner.
His question or comment is typically the appraisal is the property of the lender, not the home buyer. It's prepared for the lender, but the home buyer definitely receives a copy either at time of closing or prior to closing. So you'll definitely get a copy of the appraisal. Before you see the appraisal, we're going to tell you what it appraises for, because you're not going to go into the transaction not knowing that, because you need to know that it appraised for what you're going to buy it for. And then we're going to let you know if there's any repairs. So, any questions? Are you raising your hand, Mike?
For the internet.
Oh, internet question.
Because I was going to start typing this one, but I'm going to let you answer it by verbal. I have had direct deposit with my employer for 3 years. Can P1FCU provide income reports of those deposits?
Okay, so the question is, this person has had direct deposits from their employer into the credit union for 3 years, and can we pull income verification from internal? Is that the question? Internally?
I'm assuming so.
So the answer to that question is, we can see your deposits from your employer, but we are still going to require 2 pay stubs. And so, because what we want to see is year-to-date earnings. We want to see that it's your pay stub, that it has your employer's name on it, it has your name on it. We want to see your gross earnings, if you're on salary or if you're hourly wage. And of course, the deposit with us will just show your net. It just shows what you get after taxes and any other deductions. So there is a reason to get your pay stub. And if you don't get your pay stubs anymore, your HR department, they're out there for you. You can get them. So hopefully that answers that question. Anything else?
So there's more than 33 people of you in here. There's only 33 of you that can get this grant money, so.
Can I ask a follow-up question on combined credit score for like husband and wife?
Yes.
So if one spouse has a credit score and the other doesn't, Idaho being a community property state, how does that impact the loan application? And one party applying for the loan, one party has a good credit score, and they apply for the loan individually.
Mm-hmm. Okay, so the question is, if it's a married couple and one has a credit score and the spouse does not have a credit score, can the one with the credit score apply individually? And yes, they can definitely do that. You can even apply jointly to see if you're approvable. Sometimes you can get approved with a 0 or with a no credit score, but quite often it's easier to apply individually with the one that has the credit history and the credit score.
Does that answer your question?
Yeah, I think so.
Okay.
So if the title of the loan would be both of them, or only to the one if they're married?
It would be, the loan would be in one person's name. The loan would be, you can always put your spouse into title with you. So they're two different things. The loan definitely would just be with the one name, but if you wanted the spouse in title, you can do that as well.
But the one scenario, kind of differently, let's say you have a spouse that has a horrible credit score that's not usable, and another spouse that does, but you cannot use that spouse's income. Okay? So, because they cannot be on the loan. So their income cannot be used if their credit score is not usable.
Okay, so yes, that's a good point, Mike. Thank you. Yeah, if the spouse is not on the loan and they're the primary breadwinner, it doesn't matter, because if they're not on the loan, we can't use their income. Which brings up another factor for the grant funds. Qualifying for the grant money, the income is not the same qualification as qualifying for a mortgage. So in the case where your spouse is not on the loan, your spouse's income is not considered for the mortgage loan, but your spouse's income would be considered for the grant money. So there are two sets of guidelines.
It's a household income.
Yeah, for the grant money, it's household income.
And I always use if you got a 16-year-old kid that's delivering a money saver, that is household income. And again, it's not used for the loan, but it's used for that grant money. Two separate issues.
I have friends that are trying to get along and trying to help them. And she's got she's in a student loan debt. So that would be great. They should buy it on his income only, qualify for the loan.
Just have him apply only, yes. Because her debt would be.
Why is that?
Yeah. If that one income is enough, that's all you have to do.
For the lower end of the property.
There are some mortgage programs out there where, in the case of a non-borrowing spouse, you're still going to have to hit them for that debt. So if the student loans belong to the spouse, if you get a certain loan program, that could be the case, and maybe who knows the scenario that you were presented with. But in our world here at Potlatch, it's fine. If they're not on the loan, we don't use their debt. Of course, we don't use their income either. So.
And that difference between conventional and FHA, typically.
Does Potlatch do USDA loans?
We also put them through CU members. Yep.
Anything that ends in an A. VA, USDA, and FHA.
I see the pattern.
Any of those government loans are done through another company.
Yeah.
Yeah.
Okay.
Yeah. So.
Is it because of the nature of the credit union, or is it?
You know what really happens behind the scenes is, and I'm going off a limb a little bit, but that's typical wherever you go. They just don't tell you up front as much as we're saying up front. A lot of those things are done on the back end, and they're done either they're sold out to another company, or they keep it in-house, but they have it serviced by another company. You know, but any of those, I mean, we do a lot of stuff with Fannie Mae. Fannie Mae does not do FHA and VA and USDA. I mean, they have them kind of inside some other umbrellas, but I mean, conventional lending is just so much easier, so much better than it has been 10 years ago.
And so much less expensive. It's less expensive to go conventionally than it is.
FHAs are just horrible right now. And I mean, they turned horrible in the last 3 or 4 years. But 5 or 6 years ago, they were what everybody wanted. I mean, that was your first-time home buyer, you know, because it was a lower down payment. Well, it's 3.5%. We can do conventional loans now at 3%. The FHA insurance, that mortgage insurance through FHA, 2 or 3 years ago, it's on the loan for the life of the loan now. You could pay it down half. You're still going to pay that FHA insurance. It's on the life of the loan now. And you pay a premium up front. So.
Yeah, and on USDA, and just to further Mike's thing, on USDA, they don't have private mortgage insurance, but they have a USDA guarantee fee, which is in essence, it's same thing, almost the same dollar amount. It's just called something else. That also stays on for the life of the loan. It goes down as the principal balance goes down, but it's something that you would pay forever. But I would say Potlatch has, I personally think, and I've compared it with other lenders, the lowest costs, the best rates, so, and for a conventional product that you're going to find, so shop around because you'll find that's true. So, anyway. Okay, I think we're about ready for giveaways, and we just need Vanna up here. Vanna White, please come forward. Unless you guys have any other questions.
Thank you.
Okay, you're welcome. It's our pleasure. Okay, so we have a number of giveaways, so pull out your lucky ticket.